Our next guest says the U.S. economic crisis had one key root cause, and that is the trade deficit. Marc Faber is the editor and publisher of the Gloom, Boom, and Doom report. He joins us this morning along with Frank Berlage, the CEO of Multilateral Partners Global Advisory Group, and our guest host, Governor John Engler. Guys, good to see all of you. And Mark, we're going to get some trade deficit numbers later on this week. Why should we pay attention to them? Because too often I think they do get ignored a bit.
Well, I think it's very important to understand the cause of the crisis. The cause of the crisis is excessive monetary growth leading to excessive debt growth, to the NASDAQ bubble, to the housing bubble, that then led to overconsumption in the US. And a symptom of the overconsumption in a country is always the growth in the trade deficit that then shifts production overseas, because one trade deficit in one country is offset by a trade surplus somewhere else. And to simplify matters, let's say it was China. So actually, US monetary policies have been very good for Asia, specifically for China, because it fostered industrial production growth in China, employment growth, wage increases, domestic consumption, increased demand for raw materials, that then lifted commodity prices. And for that, actually, the developing world, the emerging economies, including China, India, Vietnam, Brazil, and so forth, should all send a thank you note to Mr. Bernanke.
Yes, and his predecessor, I imagine, you think. Frank, you want to tie all of that with the financial crisis as we know it? Did that overconsumption then lead to overgrowth in housing, and then we all know where that led?
Well, I think you have to look at the housing market and see a run rate of 2.3 million housing starts at the beginning of the cycle. I don't think we would have gotten there without the net foreign capital inflows into the United States. And I think we've had a situation where the Chinese have endeavored not to allow their currency to appreciate, and by doing so, they've placed a lot of money into the United States. Those funds, I think, overwhelmed the financial system and caused a lot of the crisis that we've seen today, excess growth in residential real estate, excess growth in commercial real estate, both in lending and in projects. Right. And I think to a large extent we wouldn't have seen the crisis. Certainly we wouldn't have seen the overbuilding, because 94% of all capital investment between 1995 and 2007 occurred as a result of the foreign net capital inflows. So if you took out those net foreign capital inflows, I think you would have probably seen, you probably would not have seen the crisis that we have today.
Mark, I'm curious. The president in January talked about the strategy. He said he wanted to double U.S. exports. We know that in looking at exports, if we exported merely the average of the OECD nations as a proportion of our production, we'd have no trade deficit, even leaving energy in. What is the export strategy for the country? Is that, under the current policies, simply not attainable in your view?
Did you ask me?
Yeah, well, maybe you both want to comment, but
yes, I think it's a dream to think that the U.S. can double its exports in the manufacturing sector, but I think that the U.S. can export more in the agricultural sector, and that the revenues from agricultural exports can go up because of higher prices for agricultural commodities.
But so Mark, egg exports in a year, egg exports in a year, Mark, are what manufactured goods are each month. So it's a de minimis as a percentage of exports.
Well, I don't see why we can't substantially increase exports, because if you look at China, China's industrial production is about 49% of GDP. Japan is about 24%. Germany is about 29%, and that's excluding agricultural products. Mm-hmm. The United States is at about 10%, and if you take a look at that 10%, a good proportion of that is simply the assembly of foreign components rather than vertical integrated manufacturing in the United States. And so I think I agree with Mark. I don't see us doubling exports without a substantial tax policy to orient ourselves in that direction, but I certainly increase it substantially.
Mark, you say that that the Fed should be getting thank you cards from some of these emerging economies, China specifically. Why then all the criticism of the Fed over the past couple of days? And do you think we're reaching some kind of crescendo on that front? And will it make any difference about their policy?
Yes, I think the criticism arises because we have too much of a good thing. In other words, the Fed's monetary policies now lead to some kind of bubbles in emerging economies through capital flows. Now, these incoming liquidities, they can be absorbed in two ways. Either let the currency appreciate sharply, or you have domestic very high asset inflation, or a combination of the two. The problem is with all this that once the speculators see that, say, the Thai baht or the Malaysian ringgit appreciates and that asset prices in those countries go up, they pile in even more, and then you have even larger speculative bubbles. And excess liquidity and dropping dollar bills onto the United States from helicopters like Mr. Ben Bernanke suggested, the problem with that is he doesn't know where the money will flow. And in this case, this excess liquidity flows into emerging economies and into precious metals, and new bubbles are building up that at some point in future will burst. And then you have another problem on your hand, the way you had a problem after the NASDAQ bubble burst and the housing bubble burst.
Yes.
Joe.
Frank, one last word. Yep.
Yeah, I was just going to say I agree with Mark that liquidity issues are key, but I don't really anticipate that we're going to be able to get out of this without some inflation. And I think Mr. Bernanke really is a janitor in this particular circumstance. He is cleaning up the mess from Congress, the state legislatures, Mr. Greenspan, and I think he gets a little too much criticism because I think he realizes that without salvaging the real estate market, we're going to see a destruction of the banking industry, and with a destruction of the banking industry, we're going to see a decline in the money supply similar to 1929. And I think if we really were seeing a depression similar to 1929, people would be calling for a lot of the actions that Mr. Bernanke is taking. I don't think he wants inflation. I just don't think he sees an alternative, because a guy who's making $4,000 a month and he's got a $2,500 a month mortgage payment, you've got to get his income up to $6,000 or $8,000. And I think on a nominal basis, that's what they're going to try to do, is float the boat on a rising tide.
Yeah. Too bad the instruments are relatively crude to get that thing done. Frank,
blunt.
Mark, always good to see you guys. Appreciate it.